Hello, traders. It is Wednesday, February 12th, and it's time for our live event. I can't say weekly live event because we haven't done one in a few weeks. It's all my fault. I'm just getting a little bit burned out. I got awful lot of things going on right now. Been writing my book, so it's keeping me busy. But I wanted to make sure that we got another one of these in soon. Harry, how have you been doing?
I've been doing well. Some great trades. Despite the fact we have a very I think we talked about before, whipsaw market at the moment, but it's everything seems to be moving around pretty well.
Yeah, this market is, I've been bearish, okay, but I feel like there's just not enough bad news to knock this market down. And it's going to take, it's taken plenty of body blows and body blows and body blows, just like today, the CPI number came out, but it wasn't enough to rattle buyers. So it's still going to take time. And from a trading standpoint, it's like you remember Forrest Gump when he had those leg braces on. Well, that's kind of where we're all at right now. It's like there's just nothing to trade. The market's not going anywhere, and sooner or later, those braces are going to come off, and then we're going to be running and doing all sorts of trades. So we just need that breakout.
He's so smart, Jenny. Jenny, he's so smart.
so we're going to talk a little bit about how Harry's been able to make money in this market because he's been really dialed in on his stock. But first, I just want to go through my last pick. It was Tesla. That was actually kind of a whiff in one regard because I highlighted Tesla about 2 weeks ago. I liked selling an out of the money bullish put spread on it post earnings, and we were short this 365, 360 bullish put spread. And that's the horizontal support I was leaning on with the 50-day moving average. And we were safely out of the money. Everything looked great. And then all of a sudden, the stock started to roll over. Well, that spread I legged out of. I did a video on it. I was not successful in it because I happened to do it the morning of the tariff talks. And the S&P rallied about 50 points in a 5-minute period. But anyway, please go back, watch that video. I described what the process was, how I ended that trade. But given the price action and the information that I got throughout having that spread on, I knew that Tesla was ready to roll over. I'd been watching it. I was dialed into it. So my trade from Sunday was to short Tesla. And if we go into a 15-minute chart, you can see this was the price action Friday. So this would have been where we opened Sunday. So there's, Monday morning. So there's Monday and there's Tuesday and today. So that's actually been a nice short pick. And it's going to happen sometimes. You're going to get some stocks where you're leaning on support levels and they fail. And when they do, that's a sign. And that's what Harry's been able to do with Nvidia. So during this quiet, kind of sideways, choppy ass market going nowhere, I'd like Harry to spend a little bit of time to tell us about how he has been approaching Nvidia because he's just been killing it. He's just been grinding on that
Yeah.
stock.
Look, I mean, we've talked about this a bunch of times. Certain stocks have a personality, so to speak, for lack of a better description. They, obviously, Boeing is a schizophrenic stock, right? It's a stock that's really hard to trust. And when I say a stock that's hard to trust, I mean a stock that does not really abide by technicals, and that could be because it's a low float stock. It could be because it's news sensitive. It could be because it's the spawn of Satan, like Boeing is. Uh, so different stocks will have different personalities. Some are very news sensitive. Um, some have, and you can kind of look at the ATR, right? The ATR is kind of like a personality test. You can look at the ATR and look at the percentage of that ATR to the overall stock price to see, just how choppy is this stock overall. And then you look into why. So, NVIDIA obviously during its early years was on this unparalleled in stock market history almost meteoric rise all the way up, and obviously it split. But Nvidia was one stock that, if you could say, all right, what was the stock of the decade so far? It's Nvidia, right? It's settled in. When I say settled in, meaning every piece of news that drops, and there was some fairly major news this morning on Nvidia about shortages on the chip side and how they'll be selling out. Normally a bullish sign. Um, and the stock doesn't really react as much. Now, whether or not that is because institutions have become so much more in tune with the stock that these news drops are almost after the fact. In other words, institutions are pretty much priced in whatever these news drops are. They've either guessed it, or they knew about it leading up to it, or they priced in, this has a 90% chance of occurring or something like that. Either way, it is not as sensitive to news drops. So it starts to fall into a much more technically restrained pattern. And the good thing about Nvidia, though, is that it always has the liquidity. So the stock moves, right? One way or another. This is not a stock that's gonna sit there and not do anything for the day. It's going to move. And you can look at that. It's always reflected in the option prices. You just look at the price of a straddle on a stock, and you can see how much movement they expect. And Nvidia, it's always priced in a decent size move for the stock. Um, I have been, over time, getting to know the movement of Nvidia. Now, certain stocks will tend to pop early in the morning and then sell off a little bit more during the day, and that could be institutions are active on the stock in the morning, and then retail comes in and kind of starts selling as volume drops. Using that, I was able to go long in Nvidia. I was able to weather a decent drop in the stock, hold on to it, and then take a $7 gain on my long position. Then I was able to get out 2 days ago before the stock started to drop. I got out around 134, 133.90. And then yesterday I was able to short it and take another gain this morning. Now I'm running behind on the short for Nvidia today, but that's also because I have the market starting to go into the gap. So waiting for that relative weakness to reappear in Nvidia and hopefully take gains in another short today. That's all I have on Nvidia.
So we had the really big drop on January 24th. And was that where you initially started to short the stock? Was like on Jan 27th when it challenged the 200-day moving average?
When I started looking at it, I shorted the stock on the 31st after it finally, I see this
Mhm.
constant testing of the 200 SMA. Then I closed it out, I think, on the 3rd of February or the 4th of February, took some gains there. Then I
Mhm.
waited. I really wanted, 200 SMA is probably the holy grail of those SMAs and technical indicators. It's an indicator that both short term and long term traders and investors use. So in that sense, it gives even more potency because there's more liquidity behind it. So I was really waiting to see that break of the 200 SMA, which is what I got. And I went long on the stock, I believe, on February 6th, or about a week ago. Rode that up. There was a little bit the next day on the 7th. I had to take a bit of a hit and waited on that. Rode it up and then sold it off right as it was hitting the 50 and 100 SMA on the chart. It got rejected there, yes, 2 days ago, got rejected there yesterday. And now you see this combining of the 250 and the 100, which is coming in at 135. And that's a pretty strong resistance point there when you get both those SMAs combining. So I remain pretty bearish on it. It really needs to show me it can break through that 135 and then confirm above that line in subsequent days. If we could show that, then I'll start considering being bullish on stock again, but we'll probably start getting closer to earnings at that point.
Right. Yeah. Yeah. That's awesome. Well, thanks for that. I absolutely agree with the 200-day moving average being much more significant. And for the reasons cited, that it's long term and short term money that's looking at it. When you start getting into 20-day moving averages, that's all short term. Day traders look at that. The 50 is a bit more significant, but still very short term. So the 100 and 200 day are the ones that I put the greatest amount of weight in. hence why they're weighted pen width wise more heavily on my charts. I
Mhm.
had a stock CPRI that I highlighted about a week ago. And in lieu of these weekly live events, I've tried to at least get a video out on Wednesday or Thursday. And so, similar situation using the moving averages. So, on Wednesday, the stock dropped incredibly post earnings. You can see that earnings before the open. And that's where I highlighted this as an excellent short. But look at what it did. It opened here the next day, which was Thursday. Look at that rally up to the 50-day moving average. When I saw the stock poke through that 50-day moving average and try to enter the gap, what I wanted to see on that move was I wanted to see sellers come in and to identify that as an excellent entry point to sell more shares. And that's exactly what they did. And it was right in here when it tested that. So I saw this fail and this rejection from that 50-day moving average, instantly shorted some shares of stock, saw the stock continue to fall, added to shares. And it's a $22 stock. I think I made like 50 cents on that. That's a really nice gain on a small priced stock. So pay particular attention to those major moving averages.
Someone asked me if I intend to hold my Moderna shares over earnings, and the answer is yes. Uh, we obviously say don't hold over earnings, and that is a general rule that you should just abide by and not make that type of exception. I'm making the exception here because at this point, if you look at the chart, Moderna is below its levels before even the pandemic. In fact, if you break down to the actual value of Moderna, without any projected value that you normally put into stock, the actual cash value of the company is above the current price. So the earnings would have to be so historically bad, sort of, hey, we set all of our labs on fire and said screw it, for this stock to drop anymore. Now, is that impossible? No, but I do believe that I have enough of an edge on the upside to hold the position there, which is a rare thing. And obviously, I would never recommend that. But the reason we don't play earnings is because it's 50-50. It's like you might as well just go to Vegas, right? Go to Vegas and have a better time than you would playing earnings. But if I ever feel I have any edge, whether informationally or otherwise, on earnings, then I will tentatively dip my feet in. And so, since I already have the position, I am holding the position.
All right, let's take a quick look at the market today. So I did short futures this morning before the open. I shorted them actually before the CPI number. I felt that the market had a very good chance of falling, a much higher likelihood of falling on the number than it would have to rally on the number. And so I cited all the reasons. Hourly wages have been going up. The CPI had been creeping higher. The fact that Treasury yields have been going higher. The fact that the Fed had paused, but it wasn't looking for a rate cut, except for maybe in June. They're talking 2 rate cuts versus previously 4 rate cuts. Lots of reasons why I thought this number might come out a little bit hot today. And so I shorted before the CPI, got a big initial move, and actually added before the open. But my thought is I've been bearish for quite a while. I think it's just going to take a number of bad economic releases to soften the market up to where we finally get a drop. It's already happened on a global basis, just hasn't happened domestically. So I was perfectly happy hanging on to the position today. And then I saw these first 6 candles. That is a really nice, strong bounce in here. So that tells me that buyers are not just going to roll over and play dead. This gap is probably going to fill, get this nice big pullback in here, and then another spurt higher. This is some pretty dang incredible volatility. I did take a small gain of about 1.5 on the trade. Yeah, I had, I don't know, probably 40, 50 points in the trade at one time. but I try not to focus on what I have in hand if my longer term thesis is that the market is going to sell off. And I felt that there was a good chance that the 50-day moving average today was going to fail. So that was my reason for taking the trade in the first place. So I'm not just going to look at how much money I've got on the table and bail out of it. But once I saw this type of buying action, I did cover for a gain in here. And I realized that, yeah, the market's just not ready to roll over yet. And here we are in the gap. We'll go to a D1 chart. And if you zoom in, this is just a spattering of green and red candles all over the damn place. There's nothing going on here. So I still like being sidelined for swing trades. I think you can trade from both sides to day trade and just take it as the day comes. So I don't have any great market analysis for you because I don't see the market really going anywhere. If anything, I think in the next month or two, based on global economic conditions, it's going to come to the US, and then we probably will see a sustained drop. But for right now, we're in a horizontal trading range, so trade it as such. Did have a
I have a
question? Like, go ahead.
I have a theory on the market. And Kyle Davies, your name reminds me of the former head of distribution of some studios. Do you fellows have an opinion on why the hot CPI drop doesn't seem to be sticking? I've heard some people saying it's bullish, and that's sort of what we were all just talking about. I have kind of a crazy theory here. For those of you maybe who've been in some volatile relationships in your past, right? And okay, and you have these mini breakups, right? So you have these mini breakups, but you do them and okay, we're going to get back together, right? You storm out, you stop talking, you stop texting for like a few days, but okay, we're going to get back together. And then eventually it gets to the point where you realize the next breakup, the next one is going to be it, right? That will be the big one. Like we're not going to recover from another one. And so at that stage in the relationship, you begin to tiptoe around each other. Things that normally would have resulted in someone storming out and slamming the door, you kind of give a little bit of grace period to, because we really can't handle another one of those. I believe the market right now knows that the next big drop, right? It's basically holding on to this bull market for as long as it possibly can by the skin of its fingernail, like just by dear life, holding on to this market, because it knows that the next time we get a correction, the next time we drop, the next time we sustain below SPY 600, it will not be as easy to recover. Every time we've had those drops before, and every time we threatened to go into the election gap before, we've always, bam, pop back up. Those are those mini breakups, right? Bam, I'm upset with you. The market's like, hey, I'm upset with you over tariffs, boom. But then boom, back up. Hey, I'm upset about this, boom, back up. I don't like these earnings, but then boom, back up. There's so much that right now could go the other way. I think the market and the institutions know that the next time we really take that dip, it's not going to be as easy to bounce back. So they're kind of holding on for as long as they can. I don't know if it's going to be a straw that breaks the camel's back situation or some real big news that does it. I just know the next big drop will be real.
Yeah, and kind of the precursor for all of this, like I've been mentioning, that on the surface, everything looks great, but it's this undertow that you can gradually feel the sand slipping from underneath your feet that has me concerned. And when I look at global growth, so PBOC has eased like nobody's business already last September, October. Their economy has not rebounded. Although, if you look at their numbers, they're GDP growth is at 5.3%. I look at lots of other information. In fact, I don't even look at what China reports number wise, but I do look at US companies who are doing business in China because they are regulated. Do not look at Alibaba and Baidu and the rest, because those are shell companies. They don't even have to adhere to US reporting regulations at all, which I think is a complete farce. Anyway, Las Vegas Sands, they do have to because they're listed here. Apple, they have to. Starbucks, they have to. And if you look at all of them, sales in China are tanking. Okay. So that gives us an accurate read of what's actually happening there. If you look at Europe and their GDP growth in aggregate, the EU, I think they grew GDP at maybe 0.1%, 0.1%. If you factor in 2.5% inflation on a real basis, they do not have any growth. And even our growth came in at 2.3% on the last GDP number. It's on a nominal basis. On a real basis, we're flatlining at best. And I'm seeing job growth is going to be an issue just based on Challenger Grain Christmas, the JOLTS numbers, the average hours worked. All of that is declining. So it's going to take time, but unfortunately, I do see economic conditions here deteriorating. So we'll see when that shoe drops. But for right now, we're going to stay in that trading range. And until it does, we trade the range.
Someone wrote, basically here, where was it? I have a bias towards weak stocks. We see this a lot, right, Pete? Like, I like stocks like CELH and Crocs and Nike. Basically, those lower right-hand quadrant stocks. And my answer to that, and to your credit, you're basically saying, how can you fix that mindset, right? Because so you at least admitting that this is not the right way to look at it, which kudos to you on that. That comes from an investor's mindset. Not that you're an investor or anything, but as you grow up and you become and you hear about the stock market through school, through friends, through your parents, through news, whatever. It's all centered around an investor mindset, not a trading mindset, an investor mindset. And an investor mindset always is buy good companies at the best possible price, right? The Warren Buffett rule: find a good company on the 200 SMA, buy it. There you go. Boom. Move on to the next one. Hold it. You're always trying to get a good deal, right? You're waiting for that pullback. You're waiting to buy the dip, and you're looking in those, and you're like, oh, well, Nike's a good company. It's been around forever. I buy Nikes. I have Nikes. The stock's been suffering. Fine. It's a good time to buy. That's an investor mindset, and that's why you're looking at it like that. You need to look at it as a trading mindset. An investor mindset will go, oh, this is on sale. I want to get it. Our trading mindset will go, this is more expensive than it was yesterday. That's a good sign that I should go long because that's the current trend. I don't care what it's going to be 6 months from now. I don't care if I'm getting in at a terrible price. I don't care if I'm buying BABA at 119 here when it was 90 just a few weeks ago. I care that tomorrow it'll probably be 120. And then I'm out of the trade. I don't care about the fundamentals of it. I don't care about any of that. I just care about the market and the trend of the stock. So you're in an investor mindset. You need to trade it to a trading mindset. That's your whole problem wrapped up.
Let's take a look at Bob. Let's take a look at BABA. And so, yes, I agree with everything that you've mentioned there. And if you look at this stock and it pulls back from this high and you're thinking, wow, this is such a nice run up on the daily chart. This is back in September of 24. And you get this pullback and you're thinking, oh, this is it. This is the pullback that I've been waiting for. And so you buy some here, and then now you've got this next really big leg lower without telling you that the stock is going to move higher from here. Uh-oh, I didn't have that technical confirmation. Stock continues to drop. Oh, this looks like a really good place. Look, I'm going to buy it at the 200-day moving average, or maybe you buy it now that it has this little pop here and the stock continues to drift lower. When you have a stock that's been buried like this, you need to see multiple signs of support: higher, low, double bottom, stock getting through major moving averages. Then, and only then, do you start taking a position in that stock, because there are signs of life, and the signs of life have come from institutions coming in on heavy volume, and they want to own the stock now. So that is your entry point. And as far as buying dips and getting good value, you're looking at strong stocks that have rallied up but have pulled back along the way. I don't know. I'm just going to bring up Apple to see, So in this case, you're looking at, hey, I like Apple. This is a nice dip, but the trend is still higher. So when it gets back above the major moving averages, I'll buy that dip. I'll buy that dip. I'll buy that dip. But I'm not buying a stock that's had its head handed to it. Those have serious flaws.
Okay, I agree. And by the way, what Pete was just saying there is a perfect addendum, because as a trader, when I said your trading mindset to your investing mindset, you're a trader, you're looking at technicals, right? As an investor, you're looking at fundamentals. And when you're looking at those stocks in the lower right hand, you need to be looking at the technical. Where is the support? Where are the moving averages? Where are the trend lines? Where can you be confident that you have confirmed that the stock is bouncing off that support? All of those things come into play, and that is what matters. And the great thing about technicals is it matters whether stock's in the lower right hand or the upper right hand corner. It still needs to meet those criteria before you enter into a trade. And like I said, trade, not investment. There is I am avoiding some of the, hey, what do you think about this stock question? Because I would like to see some of you actually put some thought into the actual question rather than just throwing out a stock name. But what considerations? Oh, wait, here's a good one. How do you become more confident into adding to winners? You guys have seen me do that time and time again with like Nvidia. Recently, I did it with Target. I did it with a couple of trades where I've been adding to the winners. And Pete, I don't know how you go about it, but you really have to think about when your trade is, and assuming when you make your trade, right, and you're up, right, let's say you go long on a stock and you're up $1 on per share on the trade, or 50 cents on the option, and there's no resistance right there, right, in which case, okay, you want to hold off, wait to see, does it break through resistance? Great. If not, then you can close it, take the profit. What you have to think about it is, you were right. Your thesis, whatever it was that told you to get into that trade, that said this stock's going to go up in the short term, you made your analysis, your technical, whatever it was, you were correct, right? So you first have to look at it like, I was right about this. Then you have to think, okay, now imagine I bet on, imagine there's a Super Bowl and you bet on the Eagles, right? And it's halftime. And you're right. You're doing well. Now, is there a chance that the Chiefs can come back in the second half? Yeah, okay, they've done it before. But you were correct. Now, let's say the person you bet with gives you the opportunity. Hey, do you want to? You bet $100 on the Eagles. Do you want to make that $200 right now? You'd say yes in a heartbeat, right? Not $200, but you have to give me 30 points, or $200, but I get 5-1. No, someone just offering you, hey, do you want to double your bet? It's halftime. You're up by 28 points. Do you want to double your bet right now? I think you'd say yes in a heartbeat. Like you made the right bet. You're winning. Of course, you double it. No conditions, of course. Same thing on the stocks. You just got to see it that way. You are correct. And it's having faith that you are correct in your analysis and that the technicals still allow you to add. What do you think, Pete?
Yeah, I agree with that. I mean, how awesome is it? You've been in this position a bunch of times. How awesome is it? You're short a stock, okay? You got the market wrong and the market flies higher, and you're watching this stock just sit down there. It hasn't even blipped higher. You're like, oh, there are sellers in this baby. As soon as the market starts to roll over, this thing is going to hell in a handbasket. So that's your confirmation in that instance. It's not necessarily price confirmation. It's confirmation that the market should have pulled this stock higher, but that the selling pressure is so great that it couldn't get off the deck. So boom, you add to the position. Okay, now let's say the market flatlines and you start to see a couple of red candles in a stock that you're short. and those red candles are nice and long. You got heavy volume, and then along comes a little green candle. Blam! They erase that thing instantly. Play whack-a-mole with it. I mean, you get these signs of confirmation along the way, and you're always thinking that, I'm going to start out with a nice position, but I know that I have to have all the influences come together at one place and one time, and they don't always come together. So if they happen to, then I'm going to be adding the position and adding to the position and adding to the position. And if they don't materialize, I'm going to stick with my starter position, and I'm simply going to manage my profits. So you don't always get a chance to add and have big positions, but when all of the puzzle pieces do fit together, you're very confidently adding and adding and adding.
Let's see here.
And right now it's hard to add to positions because you do not have any support from the market whatsoever. It is all over the board.
Yeah, it is. I mean, I'm looking at it, in the one sense you could say, all right, we are obviously closer to the all-time high than anything else. Okay, great. You can look at the daily chart and say the market's bullish on the daily chart, maybe. But you could also say 600 is a line in the sand. We are not venturing too far from that. In fact, we were below it just this morning. Just this morning, we were below 600. But then you look at the other side, and so we can say, well, yeah, but it bounced off that 600 line of 600 support and is now entered into the gap of what started out to be like a $6 drop on SPY, is now only $1.50 down. And the market is, oddly enough, still down today. You can look at the market and be like, oh, we're bullish. No, we're still down on the day off a hot CPI number. But, so that kind of, it's, when you can look at the market and say, I'm bearish and put up a good argument, and look at the market and say, I'm bullish and put up an equally good argument, that is a sign that you need to go and be very light in your trading. That is a sign that the market is not giving you really any real direction, because you'll find plenty of times where you could say, I'm bullish and put up a better argument than the other side, or I'm bearish and put up a better argument than the other side. I believe right now both sides of the bull-bear argument have equal weight, and that means you look for your individual stocks, right? Look for the stocks that on a daily basis. Be careful with your swings, take stocks that tend not to maybe be, if you're going to swing a stock, that are not as market dependent as others. But yeah, I think it is a difficult market right now to be a swing trader in at the moment.
Yes, and so let's go back, year and a half, 2 years ago, when you're in this mode right in here. Well, you've got the market tailwind, okay? Every little dip is gobbled up. So when we talk about being able to add to positions, if you're long Nvidia or whatever stock you're trading, and you've got this kind of market tailwind, you're just adding, because now you've got price confirmation. Every little dip, zoom, that's an excellent buying opportunity. You start to get into sideways, kind of choppy, compressed candles, light volume rally in here. You start taking your gains. You wait for a dip. You get the dip. Oh, there we are above the 100-day moving average. It's time to go back in. Take a starter position. All right, we're back above the 50-day. Add to the position. All right, we're making a new all-time high. Add to the position. So you're adding. Oh, there's a little dip that's gobbled up right away. You add. Okay, there's no question, because look at this market trend. Every little dip is gobbled up. And then we've got this garbage right here, where it's not gobbled up. It's like, oh, look, that sell-off, it sold off even more. And the same thing on the upside. You get some little follow through, but only for a day or two, and then they smack it right back down again. I did have a question from one of you. You'd mentioned, hey, Pete, you had a really good comment from the Reddit a couple of weeks ago, where you talked about fading the first move of the day. And yes, I do post comments in Reddit. I read all your stuff that you post, and I try and comment on those articles. And somebody had FOMO, and I said, Just go back and look at the first move of the day over the course of the last 3 weeks. Okay, the market is going nowhere. If the first move of the day is wimpy, the best way for you to avoid FOMO is to evaluate that first move. And if you've got mixed overlapping candles on light volume, that first move is bogus. And if that first move reverses and you start to see signs of resistance or support, and let's go back and take a look at a couple of them so you know exactly what I'm talking about. So you've got this gap down on this particular day, nothing going on here. You get a couple of candles off the low and then a compression. Okay, you can short in here with confidence because you're near the prior day's high. There's a green candle on the high of the day, followed by a long bearish engulfing candle. Ding, 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 ding. I think I can short weak stocks that have not been able to rally with the market. This is your entry point. Whoop, you get your drop, you take your profits. You go back to another day. There's your gap up. You get this wimpy ass little move with mixed overlapping candles on February 10th. You get this nice long green candle on the high of the day, and it's given up instantly. All right, there's a chance for me to take a nice short position. Looky, we get below VWAP. Awesome. Starting to find some support in here. Take your gains. So yes, that's that. Looking for that first wimpy move. Look at that little wimpy move right in there. Tiny mixed overlapping candles on February 7th. Hey, I'm looking to short. Get a nice long red candle, plenty of follow through. Could go through every day and show you this, okay? So yes, that's a really good strategy when the market's not giving you anything to really sink your teeth into. That first move is wimpy. You're licking your chops. You're waiting on the sidelines. You're looking for stocks contra to that move. And you enter the trade. That's how you're going to make money day trading.
Strange question here. I have a neutral bias on SPY until we clear all-time high or daily 200 SMA on huge volume. Thoughts on a far out of the money short condors on SPY, QQQ, IMA, IWM, SMH, other choppy stocks or sectors that have liquid options? It's almost a contradiction in terms that you're saying a short condor and a choppy stock. Why? First of all, a short condor is a credit spread, right? So basically you're doing an out of the money call credit spread and out of the money put credit spread. Whenever you're doing a credit spread, your risk reward are flipped, right? So if you're getting $1 credit, you're risking four, right? If it's an out of the money. So when you have that disparity, when you have a credit spread, meaning the maximum money you can make is the credit that you're receiving, and the maximum you could lose is the spread between your long and short position and minus the credit, is always going to be 2, 3, 4 times as great. You have to have a high probability of those trades being successful, right? So if you're making $1 credit for every 4 that you're risking, you have to be successful more than 80% of the time, right? It's just simple statistics. So when you're doing that now on indexes that you admittedly say are choppy, and we're at an inflection point, a fork in the road, meaning if it decides to it's going to go all the way up or drop like a rock, the death of short condors are big moves. So on any given day, any news break that come out, any PPE number, PPI, any number that comes out that could change the market, you risk getting completely upside down on these short condors. Or any of these out of the money short plays, credit spreads, and you won't be able to get out. So I think it's a terrible idea. But long story short, short story long, whatever it is. Yeah, I would not do that.
100% agreement. I've been doing this for 30 freaking years, and I have seen people sell iron condors and look like an absolute hero. I got a 94% win rate. You're an idiot. You don't know what you're talking about. And then they get freaking annihilated. And unfortunately, I've had some customers when I was on the brokerage side of the business that just kept compounding and compounding and compounding. And man, they had just beautiful positions. And it's like, man, look at this guy grow this account. And then all it took was
Yep.
one event, and they got screwed royally because it was a whipsaw. And so here's the thing about iron condors. Okay, you're going to feel like a hero. You're going to feel like you know everything there is to know. You're going to make money very consistently for many months. Okay, and your thought is, well, I'm going to cover this position when we get to an extreme or we break out. Okay. And the problem with that is you don't know when that event is going to come. It's going to be a fat tail event. And that means that it's going to go way beyond 2 or 3 standard deviations, that everybody is expecting. Okay. Well, why? How does that happen? Because you've got these gamma exposures on the outside of the range, so that when it finally does go through, everybody's forced to cover, and it fuels the move much faster than you could ever imagine. So if you're hedging with futures, then good luck to you. You could make that work, but you have got to hedge with futures if you don't know how to do that. And that will protect you in big after hours moves or before the open moves. So if you're short these condors, you better damn well know how to hedge with futures contracts, because you're going to get hit, and you're going to get hit hard. You're going to be in a situation too where there might only be 1 or 2 times a year when you really needed to close that spread down. Well, which was that time? Because there will be many times when you get close to danger, but not quite there. And then there's going to be one time when you absolutely blow through it. And it's like, crap. That one freaking trade took everything away from me that I've just spent 10 months trying to accumulate. And I mean, you talk about deflating. It's heartbreaking. It's devastating, because you're kind of counting on that money month in, month out, week in, week out. You've made that money. Okay, the position is gone, and all it took was one time. So
Like
great that you're
99%
doing
of the time, I can run into traffic and make it to the other side. Yeah, but the one time you don't, you get fucking hit by a car. Besides, Pete and I are here showing you where the goddamn crosswalk is. Use it. Like, you don't have to run into traffic anymore. Yeah.
There's a reason we're directional traders, and it's because I've seen neutral trading strategies. The difficulty with being a directional trader is that you have to put in just an inordinate amount of time into your analysis on the market and on the stock. But big money is made being directional traders. Okay, I'm telling you. You look at George Soros or any of the other guys who've made tons and tons of money. It hasn't been by nickel and dime scalping. And
Steve Cohen.
if you think that's where your money is going to be made, is just getting in and out of tiny little positions and selling premium and not having any opinion whatsoever on anything, I'm just going to sell premium. Well, good luck. Okay. Go ahead and try it. I think everybody should try every strategy. I've sold a ton of iron condors. So when I tell you that this is going to blow up at some point in time, just keep doing it. Keep it in mind. And then, you can chalk that one up to experience.
Someone said, I realize I'm more confident in shorting stocks than going long. How can I address this problem? This is definitely a mindset issue. This is, I mean, you must have gotten your ass kicked throughout life, constantly expecting the other shoe to drop. You must have had so many trades go against you where they drop like a rock for you to go, I am more comfortable in the red candle than the green one. This is absolutely a therapist question for you, because if over time, and I'm not just over the last year or 2 years, since the stock market began, stocks go up by and large. That's what they do over time. They will go, they'll drop, but they'll go up. They'll drop, they'll go up. As long as you hold them long enough, they go up. You should always be more comfortable holding longs particularly in a bull market, which 90% of the time you're going to be trading in a bull market. We're in a bull market. If you're in a bull market, that means more likely than not, the market will be up. So you should be more confident holding long. That doesn't mean there aren't times where you're not confident holding a short. There are certain stocks that are just fucking dying that day, and you could look at it and be like, "Wow, I mean, I'm pretty confident holding this Nvidia short right now. Look at the relative weakness it has." But you should always be more confident with those longs, and if you're not, it's definitely some PTSD scarring from your past.
Yeah, I just put up the monthly chart of the SPY. So, I mean, if anything, just take a screenshot of that and put it on your computer monitor. And every time you want to favor the short side, you should look at that. Trading from the short side is brutally, brutally difficult. Okay. I do it, Harry does it, but you have to have the right conditions. And I'll tell you that even during the 2008, 2009 market crash, if you thought that shorting was easy, it was not, because out of left field, you would have the Fed say something like, yeah, we're thinking about cutting rates a full basis point. And then you'd have, the Treasury Secretary and come out and say, we're going to do a $750 billion TARP bailout. Whew, here you are. Everything's working out absolutely great. And you are watching the market come in and you're watching the stocks tank and everything is just beautiful. And then you get walloped by a piece of news like that. And all you have to do is go through a few of those experiences, and you are definitely appreciative that it's much harder to trade the short side than the long side. Yes, there are periods where we can do it effectively, but be very, very selective.
So that's about. I'm going to answer this question on Apple here because you did put thought into the question. Thank you, Joe W. Looks like it's breaking a 7-day compression. Reclaim the 100 SMA appears to have found a base. If we had a stronger market, would you consider this for a swing? I'm just curious. My analysis is correct. Thank you for that question. No, I would not, and the reason is because yes, it is breaking out of that compression that started on February 3rd after it dropped day after earnings. However, you need confirmation, right? So confirmation would be tomorrow it is going to open above that 100 SMA. The problem then becomes what's right above that, the 50 SMA. So the moment you have your confirmation that it broke the 100 SMA, you now have new resistance. You have resistance sitting there at 240. So what I would do on Apple is I would put an alert. I would put an alert in at around 241, which means it now obviously confirmed the SMA break of the 100, and then it broke through the 50. Then I would start monitoring it closely and see if it stays above the 50, and if it does, I consider it for a long. But right now, when resistance is right above confirmation, I would not touch it. But thank you for the question on that.
Yep. And Apple's kind of a pretty choppy one. It's had some nice moves, had a nice run up there, nice sell off here. Then you got this long candle after the earnings announcement. So, yeah, I'm indifferent on it. There's a giant wedge forming as far as I'm concerned. And even, the 100-day, 50-day, you're still kind of inside of that wedge. So it just doesn't have the price movement that I'd be interested in or looking for, which might as well get to a stock that I do like, because we got to give our picks today, right? I've kind of been looking at Google as a short, and I'm kind of liking Google as a short here with a chance to get down to the 100-day moving average. So you can see the earnings reaction, big gap down. Now, Google does not move anywhere fast. It just doesn't. Okay. It just, look at this, choppy back and forth. But now it's testing the bottom end of this gap right here. And it's been holding below the 50-day moving average. What's the market been doing? Market's been holding steady near the all-time high. It has not been moving lower, but look at Google struggle to hold those gains. I mean, the market's been holding its gains, but Google has been giving it up. There's your chart of the SPY moving higher nicely into the gap, probably going to fill the gap in here. What did Google do today? Well, Google sold off, but look, it's not even challenging the high of the day. Huh, but the market is on its high of the day. Another sign that there's some selling pressure. Google did sell off nicely earlier in the day. So, yeah, I like Google as a short, and I'd be looking for it to drift because that's what it does. It drifts down to the 100-day moving average. So, you don't have a lot of downside here, but you've got probably about $5 or so. So, that's your short pick of the day.
I am going to almost mirror that with Nvidia short. If you look, the charts are very similar. You have it sitting between the SMAs. I believe you have pretty strong resistance up here where the 50 and the 100 are actually converging on each other. You have a fairly relatively weak stock today, and you have the temptation here to come back down and test that 200 SMA, which is at 124. So that gives you about $7 to play with. So what I would do is obviously that resistance above, which is those the 50 and the 100, which is at 135. So you got $4 of upside here on risk, but you have $6 on downside here on profit. So I would, obviously, if it breaks this 50 and 100 SMA, you get out of that short, right? It's now confirming that it's resuming its bullish run. But you see it break below the 15 EMA, which is at 129.67. That would be awesome. I'm short now, but that would be if you're a little bit more cautious. You should wait for it to break that 129.67, and then you short it down to the 200 SMA. Now, if it hits the 200 SMA and breaks through, by all means, add to the short. If it bounces off that SMA, take your profit, get out of the trade.
I like it. And I also like what the price action has been today. Same deal, like Harry was saying. Look at the market rebound and fill in the gap. It's making a high for the day. What did Nvidia do today? Huh. Gap down, lower high, and it's below VWAP when the market's making a new high for the day. That sure doesn't look like relative strength to me. So, yep, looks like a decent short to me as well.
This one is what our backgrounds are. Most people watching probably know our backgrounds. Did you go to school for business, into the finance world? Nothing can prepare you for this. Pete has a much more longer, distinguished background in finance. I was, got my PhD in sociology and statistics. I was a professor. Then I started predicting movie box office and entered the movie business, starting companies based on consumer feedback. From there, I went into studio on the studio side, into producing, into strategy, into assessing scripts. Started a bunch more companies, started a studio, made some movies, then started trading. And all of everything I did before that could not prepare me for the ass kicking I was going to get when I started to learn how to trade. And I could tell you, learning how to trade was more difficult than anything I did prior, including graduate school, including becoming a professor. All of that trading was more difficult, and that's how you have to treat it. You have to treat it as a job. You have to treat it as I am about to enter into law school, medical school, because that's the equivalent of what you'll be doing, and how much time you have to spend learning this before you can expect an actual return on that investment of time. But Pete comes much more from the straight trading world.
When I look at Harry's skill set, he's very good at reading behavior. And, that does actually have to do with your educational background. And then you add the ability to do statistical analysis, also very, very important. Yeah, I got an MBA. Took a lot of finance courses. All they did was muddy the water, as far as I'm concerned, because I had to learn shit like efficient market theory, where no one can predict price movement because everything is priced into the market. Yeah, right. Okay. That's why every week you and I, Harry, got winning trades that we show people, right? Because we don't know what we're doing. We've just been lucky for years and years.
That's right.
So,
Just total chance.
I don't view my educational background as giving me a big leg up. I've been in the industry for a long time. If I had to look at one thing that I think has really helped me more than anything, it's playing chess and the analytical skills that you get there, the scenario analysis, looking at which moves your opponent could possibly make, trying to figure out what their game plan is and figure out how that fits into your particular game plan, which moves are more which moves benefit you more that they might possibly make, which moves would be more difficult for you to respond to, kind of what you want, what you don't want, what are the odds of it happening, and then structuring your plan of action against that. And so it's important to keep very, very detailed trade journals to learn, and to do a lot of game planning before the open. For those of you that have followed me, I have what my vision is for the day, and I know how this game is most likely to play out. And then, based on those scenarios, I know the patterns that are going to tell me when that scenario is playing out. And then I have already a plan of action so that regardless of what I get, I know how I'm going to be responding. And there could be days when I don't really trade very much at all because I'm not getting what I want. Like today, I didn't get what I wanted, and the market is continuing to move higher. So this is an upward sloping trading channel with wide movement between. We finish and close this gap today, I believe. Let's see, we're about 2 or 3 hours from the close. This is going to be a nice move for the market. I think it's going to give bulls some confidence to see the market recover like this today. So I would not be surprised to see a little bit more follow through in the next day or two. Nothing I would sink my teeth into on a swing basis. So that's just my 2 cents worth on trading. I think the more books you read, the more you learn, the more people you listen to, does definitely help to be around other people that are successful traders.
Yeah, and do yourself a favor, turn off the CNBC, turn off the Jim Craig, turn off all those people who, what day one day will say we're in a bull market, the next day say catastrophe's coming. It just ignore them and focus on price action, focus on people that can prove that they are successful. You have so many people out there claiming that they know how to trade, and yet they're so reluctant to actually prove to you they can trade. Now, anything can be photoshopped. Anything, any statement can be. Even Kinvo is having issues with authenticity. The only way that I have found that one can be authentic to prove to you that they know what they're doing, and that's what I do, which is posting the trade in real time, posting the position size, and you can look on time and sales and say, oh, he said he bought this number of option contracts. Oh, look, there it is. Every broker shows those purchases. You could see them. They're all public. Posting the entry price and then posting exactly when I exit. That you cannot fake that. You can look back and go, yep, he was in that trade. Yep, he exited. Yep, this was the profit. Okay, there it is, right? Unless someone is willing to do that, take what they say with a grain of salt. Now, it doesn't mean that those that can't teach, right? Sometimes it doesn't mean that I haven't known some people who are great at explaining and talking about options and all that, but when they trade for themselves, they are crap. And that is an emotional issue they have. Doesn't mean they don't have the knowledge, but just make sure that people are authenticated when you try to listen to them, and particularly if they're asking for your money. We here, and Pete certainly with OneOption, I think has beyond a doubt proven not only himself but the system and the platform and everything else and the value of the chat room. But someone on YouTube going, I have a 3-bar method charging $3,000 for my quick 3-day course, and you'll make that back in a day. Okay, good luck. Have fun.
Buy on blue or sell on red. I don't know who that guy is, but he's got videos all over the damn place. He's definitely dialed into me because I see him all the time. It's just that easy. I did have a question, relative strength, relative weakness. I see relative strength, I buy, and then the relative strength is gone. what gives? Uh, you're looking at a 5 minute bar more than likely. And that's where you're going to see relative strength and weakness change. You really need that relative strength on a daily basis. Everything starts with the longer term chart. Okay. So, 200-day moving average means more than a 20-day moving average because you're looking at a longer time span. A daily chart, relative strength on a 10-day basis, that is true relative strength, and that will not change easily. On a 5 minute basis, yes, relative strength changes all the time. And that's why you need to watch what the market is doing, get your entry points down, and you need to watch what the stock is doing and read the price action in the underlying stock. If I look at Nvidia, hey, look, it's got relative strength. It's got relative strength. Look, on February 11th. Well, these are crappy little sideways candles. They don't, it doesn't mean anything. It's not even trending. And then, oh, there goes Nvidia. It drops a whole bunch. Well, I was buying relative strength here, and then look what happened. You need to have those nice, tight, orderly price patterns as well. And you need to see heavy volume. When you have that tight pattern, you know that one side or the other is engaged, and that heavy volume confirms it. So you combine that with daily relative strength, and then you combine it with, hey, the market looks like it's going to head higher here off of a dip and a VWAP check right here today at 11:30. Okay, that'd be 11:30 Eastern time. This is a nice entry point. You've got that to go off of. You've got a bounce off of VWAP. You've got another bounce off of VWAP. Probably going to be a good entry point. This is where you look for your stocks with relative strength because you're going to have that market tailwind. And do you have a strong stock you're looking at today by chance? Do you have anything on your radar today?
I mean,
Baba was
that's
on
gonna
your
really
radar,
trust
right? Yeah,
Baba,
Baba.
obviously.
Baba. Okay, so at 11:30, there's your entry point on Baba. You above VWAP here, you've got relative strength. You've got a long red candle and a bullish engulfing candle with that coming in the market. That's your entry point right there on relative strength.
Yep.
So it all has to be taken into context together. You cannot just look at one variable, and especially not on a short time frame. Long time frames trump everything.
And then you people need to remember also what what the whole point, what relative strength, relative weakness means, is to get an insight into what institutions are doing, right? Because we don't follow other retail traders. Why? Oh, 95% of them are going to lose money. Why the hell would I want to follow them? I follow institutions. Why? Because 100% of them make money. You never hear of institutions losing money. JP Morgan doesn't lose money. Goldman Sachs doesn't lose money. They make money. And what you want to do is follow what they're doing. Now, obviously, the most ideal world would be you know what they're going to do right as they do it, right? And then boom, you get right in on it as they are. But you don't know that. What you can do is follow their trend, the breadcrumbs, whatever it is. And the best way to follow the trend is say, okay, the market is doing this, but the stock is doing this. Well, what would it take now with the market doing this, the stock should at the very least, all else being equal, being dragged up, right? Not up a lot, but being dragged up with it. If it's dropping, someone is in there selling in large numbers. That means an institution is. Oh, but wait, I went in as it was dropping, and now all of a sudden it's not relatively weak anymore. Well, institutions don't just sell, 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 sell. They might be selling, see that the market is going up, and then go, oh, you know what? Change our sell price point. Let's move our price point to sell the next batch of it to be a little bit higher. Let's get that stock up there a little bit more and then sell again. Right. So you get this pause and what looks like this, oh, it's not relatively weak anymore, only to see that an hour later, boom, it's going to resume because they just wanted to get it a little. They felt they could sell it at a little bit better price based on the market, based on the price action. They felt, okay, I'm not going to sell Nvidia at 131.50. I'm going to sell it at 131.75 now. So they just re-enter in their algorithm. Bam. Nvidia pauses on its relative weakness. creeps up a bit with some retail buying. They let retail do the hard work and push it up 25 cents, and then bam, their sell orders come back in, down it goes, relatively weak again. So yeah, you'll get these pauses, but it's just because institutions aren't consistently, constantly buy, sell all day long. They're reevaluating, they're changing it.
I had a question on Target. That is a trade that I posted in the chat room today. So let me take a look at that. I am loving Target right now. I am loving it. Look at this market rally. Just like I told Harry earlier today, when you're short and you see the market run up like this, it's run up 45 points, okay? And you are short a stock and it does this, you're like, yep, sellers are in there. Wham, 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 wham. How many more you got? I'll sell you everything you want. I am short at 127.38, so I'm down about 90 cents on it. What do I think about it? I love the gap down. I love the fact that the stock has not been able to get off the deck. I love that it's selling off on heavy volume. I love the D1 chart. I love the fact that it's below VWAP E. So yeah, it's below the 50-day moving average, long red candle, consolidation. After a big move, we usually don't go anywhere. Have to digest those losses. Can it get off the deck? No, no, no. Get a nice little drop today, get a nice market rebound, stock still down. If I get the market price action that I would like to have, which is weakness, guess what I'm going to do? I'm going to add to Target. I'm going to short more of it, and I'm going to do so very confidently. Am I worried? Am I worried that I'm down 90 cents on it? No, not even a little bit.
And I would do the same with Nvidia. I will add the moment I get, the moment I see Nvidia cross below my entry point, it's confirming for me its relative weakness, just the way Target is for you. I love it. And here, just, I know we're running out of time here, but Glenn said, I'm stuck in a rut, overthinking mode at learning Greeks. There's always a new point of view, which seems to be never ending. Hope to paper trade and take a break from theory. Stop. Just stop. Stop with the whole thing. Learn the concepts of the idea of option trading, what they mean, what it really means right now in terms of what happened when that option expires. What's the point of this spread? Really understand it. Don't just memorize it. Don't understand at its base level what it is you're doing. The Greeks, look, it's not that difficult to really encapsulate the Greeks, right? You have the most important Greeks are depending on your trade. So the whole point of options is leverage, right? The higher the delta, the better your leverage, right? So when a delta is 1, it's 1-to-1. When the stock moves up $1, the option moves up. It's a 1-to-1 basis. That's your maximum leverage. That's why a deep in the money option is always going to be superior than a out of the money option, right? Because in the out of money option, you're giving away your leverage. You're giving it away and paying all premium. In the deep in the money option, you're not paying as much premium. And then you have your volatility, right? And that is how much, when you just, all you have to do is look at the cost of the call and the put at the money to see. But you're focusing on the wrong things. Don't worry too much about all the theories on delta and gamma and this. Worry more about the price action, about the stock, about what learn how to trade stocks first, then move to options. If you're doing paper trading, like you said, trade shares before you trade options. Work on that. Once you get that right, then worry about the instrument you're going to use to trade.
100%. You can have all these option software. Oh, look, if I do this, the probability is that. And if I do this, then the probability is that. I don't even understand the strategy, but that's where the probability is. No, it isn't. What the inputs are what drive the software, and the input that you must know and that you must quantify. You need to know the direction, You need to know the duration. You need to know the magnitude of the move. Okay, those are three very critical inputs that there's no piece of software out there that's going to give you those inputs. Those inputs are going to come from your research and your analysis and your understanding of price action. Okay, your ability to read price. And that's where you have to spend all of your time. I haven't even written the options section of my book, although I did record about 8 hours worth of video so I could transcribe it. So I'm close to writing it, but everybody wants to focus on the damn options. And I thought when I started this company that my focus would be on options until I realized people don't even know how to trade. They don't even know how to read the market or the stock. And that is 90% of the equation. So that's where, if I want to teach people how to trade, that's where 90% of my effort needs to be. But most people don't have a lot of money and they want to strike it rich immediately. So they go right into options. Big mistake. So yeah, you have to know those variables, and you need to be able to assess what your level of confidence is in that outcome. And that's going to be based on the market, and that's going to determine how aggressively you trade it, meaning what option strategy you choose, and how many contracts you trade. How heavily leveraged is that position going to be? It's a lot to learn before the options part. Once you know all of the inputs and you know how to assess and quantify those variables, the option part is a cakewalk. It's not complicated at all, unless you choose to make it complicated with ratio back spreads and delta gamma neutral strategies, and go for it. Yeah, go nuts. But you don't need to do that. You can keep it very simple, but you have to be right on the market and you have to be right on the stock. And if you do that, everything else just falls right into place.
One quick one here from Sasha because he asked it twice. He uses alerts a lot. We're a very big believer in alerts because it serves up great treats for you every day. Um, However, I get lost and overstimulated and struggle sorting through the good and the bad when they all pop. Obviously, when you have a morning where you get this huge gap down, right, or a huge gap up here, all the alerts you have primed on a lot of these stocks that are going to be set off. Um, the best thing to do, one, is tighten your criteria on your alerts, right? Don't make them so loose because you're going to have a million alerts going off, and a lot of them aren't going to be very meaningful. So let's say you have a stock and 100, 200 SMA is at 110, right? The stock's at 108. So you put an alert there. Don't put the alert at 110. I put the alert, put the alert at 111, 110.50, 110.75. I want to make sure I get it, really clear through that estimate before I get an alert. So that's one thing you can do is you tighten the criteria for the alerts and don't make them so easy to trigger. Make sure that when they do trigger, they're very meaningful. And then when you get this huge pop up, gap up or gap down in the market, and a lot go off anyway, then it really is just a matter of first look at sectors, right? What sectors are driving that pop, right? So when you get this huge drop down, you see, oh, it's being driven by a drop in the tech sector. Well, that's going to focus your alerts, or your concentration to alerts in the tech sector, and the shorts potential there, because that's what's driving that market drop and therefore driving a lot of those alerts. Then you need to look among those alerts, how many are dropped just because of the market and how many are actually relatively weak, right? So the market dropped $6. This stock, Apple or whatever, dropped down to this. Okay, well, that's a normal drop given the market. But if you look at another stock and it proportionally was relatively weak and dropped much more than you'd expect based on that market drop, that alert's going to be a lot more significant than the one that just dropped with the market. So those are some strategies you can use to help narrow down your alert.
All right. Well, I think we're kind of running to the end of
Yep.
our presentation here. There's not a lot of news to drive the market. Okay. Earnings season is winding down. We have retail sales on Friday. That's going to be an important number. So obviously, as someone who likes target short, I'm going to be aware that that number is coming out on Friday. It will have an impact on the stock. But we're in kind of a dead spot here. We had huge window of opportunity in the last 2 weeks with earnings and FOMC and economic releases. And now we're kind of in this dead spot. We do have the PPI coming out tomorrow, but the cat is kind of out of the bag today with CPI. So are they going to, if a PPI comes in hot, are they going to nail the market tomorrow? I don't know. I mean, kind of looks like buyers are still engaged. With regards to the short that Harry and I gave you, the basis for that is that you need to have a soft market backdrop. Okay, it's, you don't want to be shorting when the market keeps going higher and higher. So you've got time to enter that short. We're both kind of leaning. We'd like to see the SPY below that 50-day moving average, right, Harry?
Yeah, that would be very key. This, both the 50 SMA, which obviously is sitting there at 598.76. I mean, that break, I like to see a break of 600, then a break of the 50 SMA, and then we can really get cooking as we head down to the 100 SMA all the way at 590.
Yep. And so for Google, it's the same deal. I'm looking for it to drift down to the 100-day moving average, just drift lower. Okay. And if I've got a market tailwind, it's going to do that pretty easily. And Harry's looking for the upside resistance levels to stay intact on Nvidia. And right now that's at AVWAP-E and absolutely that 100-day moving average. So yes, he doesn't want to see a big rally in the stock, regardless of what the market does. And if the market starts to soften, then he's definitely looking for Nvidia to roll over. And you'd like to see it take out the low from today. That would be really nice. We've got the signs there to tell us that these stocks are weak and that they're just waiting for the market to have some weakness as well.
I have to quickly address this from John Deere. Hi, Harry Pete. Over the past decade, an average 27.1% of actively managed funds benchmarked to the S&P 500 beat it annually, meaning the S&P 500 outperformed 72.9% of institutions. That is so fundamentally incorrect. You're not understanding institutions, right? Institutions are the S&P. That's what you're not getting, right? They are that index. They're 70% of the liquidity in that index. They're benchmarking against themselves. So when the S&P goes up, 15% a year, that 15% is the return that those institutions are making. The ones that are doing 27%, 28%, now you're looking more at the hedge funds, right? The hedge funds are, as you go, actively managed funds are ones that actively trade. So yes, when you actively trade, your goal is to beat the market. That is your goal. Otherwise, just park your money in SPY, walk away, buy, right? Why not? If you can't beat the annual return of the market, there's no point in trading. You're getting no advantage. So the hedge funds try to actively beat the market. That is their job. But institutions are the market. Their job is to make money every year and get that return. And that is what the market is doing. So when you're saying, oh, the institutions don't beat the market, of course they don't. That's who they are. JPM's not going to beat SPY. A hedge fund is going to beat SPY. So you'll see JPM, Goldman, they're all going to be very similar like that.
Yeah, and they also have to anticipate future cash flows. They don't know how much money is going to be coming in. They can guesstimate it based on periodic investments. And so as investors get more or less excited, they don't know what those inflows are going to be. And when they come in, then they've got to allocate them. So it's a little bit different than actively managing the position. And it's more difficult. I am not defending asset managers because I'm trying to beat the market myself. And if they were able to consistently beat the market, then I just give them the damn money. Harry's ready for lunch.
Indeed,
all right, everybody. I'm going to try and do maybe one of these a month or so. I'm just super busy right now. It's been very hard for me to do it. Maybe I'll join Harry on one of his X feeds where we could just do the audio portion of it. So we will be in touch and keep an eye out. We'll keep these going. Thanks so much for attending.
Bye, everyone. Thanks.
Thanks, Harry.